As a rule, the sequence takes place with the announcement and start of a listing project and then, in front of offers judged to be more attractive or signs of weakening of the stock market, resorting to the hypothesis of trade sale or secondary buyout. The sequence can also be reversed, especially in the presence of broken auctions, after which, after a certain period of time, the IPO project is the priority option. In general, private equity investors, compared to corporates or family businesses, appear better prepared to manage a double track, due to the familiarity and the consolidated track record in both markets. Instead of the conventional IPO procedure, there is the possibility for the outgoing fund to go public through SPAC, an instrument aimed at facilitating and accelerating the listing of SMEs on the stock exchange. In this case, the listing takes place through a private M&A negotiation between the promoters of the listed vehicle and the shareholders of the target company. Once the business combination has been approved by the shareholders' meeting, the merger by incorporation will take place, after which the target company will acquire the status of listed. For the financial investor, the listing through SPAC of an investee company presents, compared to the conventional IPO, various advantages in terms of greater agility in the procedure, greater confidentiality in the preparation phases and greater certainty on the final exit price. In conclusion, it is considered appropriate to mention two other forms of exit operations even if they do not consist in the sale of a shareholding. The first is the dividend recap, for which we mean the collection of dividends in an extraordinary form through the use of additional financial leverage, through a change in the capital structure, but not in the shareholding structure. An early monetization is made possible. The dividend recap is a valorization method strictly linked to the conditions of the leverage financing market and shows a marked cyclical nature, with substantial volumes during positive phases and vice versa almost absent in the phases of market contraction. The write-off of the investment, on the other hand, has opposite sign compared to the previous case. It is a total or partial reduction of the value of the equity owned by the financial investor. More than an exit method, it turns out to be a reduction in value with consequent capital sacrifice. Write-off is also closely linked to the economic phase and tends to increase in times of crisis. However, even in the most difficult phases of the global economic and financial situation, it recorded a non-significant weight on the total investments in venture capital and private equity, also because the financial investor has often exploited the possibility of recapitalizing the company to avoid the hypothesis liquidation or bankruptcy and to negotiate an agreement with creditors at the same time.